Okay, so number one, inflation keeps rising, and why that's bad news for homebuyers this year. This is from Realtor.com. I intentionally pulled this from Realtor.com versus Forbes or CNBC or whatever because I wanted to get the real estate
Industry
take
specific.
on inflation. Yeah. Everyone was talking about inflation last week. Obviously, CPI came in higher month over month. CPI came in higher year over year. And I would like to remind everybody that the March year over year CPI at 3.5 is cumulative. So before we get into the details of this article, remember, rolling inflation records are cumulative. So if it was 9.1% 2 years ago and it was 6% last year and it's now, let's say, 3.5%, that's cumulative. Only if it is zero or going with a negative before the number is it actually going in reverse. This is like me adding weight. So if I weighed 100 pounds 2 years ago and I added 9%, I'm 109. And then if I added 6% on top of that, then let's just easy math. Let's just say I was 115. And then I add 3% on top of that.
Essentially what you're saying is you're just gaining weight regardless how small or big the gain is.
And this is why I'm telling it right here at the top. This is important because in articles like this, there is a unintentional mistake maybe being made in that we say inflation is going down versus inflation is slowing. So I want to make sure that's very clear. If there's a plus in front of the number, that means it's still growing. That does not mean it is going down. That means it is slowing in its growth, not that it has retracted or contracted, I should say. Okay.
Did you want to talk about something about your weight after?
Yeah, we're gonna have to talk about that too because I need deflation in my pounds.
I heard a little cry for help there. I'm like,
hey, when you're talking about the cumulative inflation, I noticed you were breathing really heavy. Thank you. So inflation jumped in March, giving the U.S. Federal Reserve ammunition to hold off on eagerly awaited interest rate cuts. For the fourth month running, inflation ticked up, reaching 3.5% year over year in March, and this was the biggest cumulative increase since August of last year.
So waking up that morning last week, I was like, what?
Yeah.
And I remember sending you guys that screenshot, and it wasn't that bad. It was like 63. I was like, dude, this is the worst it's been in the last couple of weeks. I got to the office, 80. I was like, holy.
Well, wait, you have to explain what you're talking
80
about.
basis points. Basically, rates. So just so you have an idea, 100 basis points will translate roughly maybe 0.25% in increase of rates. So
to half, yeah.
Half more or less, yeah. So in the last, 3 days of last week, we basically, hit over 100 basis points. And, the rates definitely right away adjusted. And we saw them spike back up to 7.25%, more or less that range this past week.
So inflation is bad for the housing market for a number of reasons. Number one, when inflation is running hotter than what the Fed is expecting, and it's running hotter for longer than what they have said they are anticipating, they've stopped using words like transitory. They've stopped using words like soft landing. And now you have more pundits and people and analysts and heads of banks saying, hey, it's sticky. It's here to stay.
Yeah.
It's becoming embedded. And I use those words too, not just because they've said them, but this is what happens. When people show a ability to continue paying the increased price, then that means you do not need to retreat on the price. Now, on the sales side of things, on the retail side, if your wholesale prices are still high and you add your margin to that to sell to the customer at the retail side, well, if my wholesale cost is still high, I'm passing that on to the customer. That's how it works everywhere, whether it's the drive-through or at the Walmart or the gas station or whatever it is you're buying.
Fast food supply chains.
So you have to go upstream. And so the problem here is that it really comes down to the bond market in the mortgage-backed security market where mortgage money comes from. If it is if it looks like inflation is going to run rampant and run higher for longer, then the market has to keep its margins in place in order to continue offering money to be lent out to people, which only means mortgage rates stay high or go higher, and they will find a new local level in the future.
Yeah, and that's the tricky part that we keep, going up and down in this these rate environment that, a lot of people, unfortunately, one day they're approved, other day they're not approved, other day they're back in the market, other day, they're not in the market. And it just seems like we haven't found a healthy medium where this is going to tank and just kind of be our new norm for as where rates we can expect them to be. Because on any given day, a lot of the rates can change from one day to another. If you saw last week, just like, that quick.
Yeah, and what Brian's saying is really important to understand. If you're in the market and you're looking to buy buy a home, or let's say you're refinancing right now and you're looking at the mortgage market, talking to your loan officer, the mortgage market can change every minute that the open market is open. So when the New York Stock Exchange is open and it's trading up and down, the bond market's open, those mortgage rates are vacillating as well, going up and down or sideways. And on the day where CPI got released last week and it was higher and hotter than expected, the bond market went up right away.
Yeah.
And you saw the 10-year yield jump from 4.3, like all the way to 4.5, and then hang around 4.5 for a day and a half, and then went past 4.5 a little bit. Well, when that happens, that spills over. I shouldn't say spills over. That correlates really strongly with mortgage rates. It's historically had a large correlation. And this is not what the Fed was expecting. It's not what they were hoping for. And it's I can't say it's blowing up in their face. That's a little bit extreme, but it does indicate that what they're hoping for is not happening at the speed they were wishing it would.
Yeah, and I mean, and you're going to start seeing a lot of people digress from what they said about the rate cuts. I honestly maybe think that unless data gets a lot better by September, they might not even cut September and wait until December. I mean, I don't quote me, but I feel the way that things are and the way that I've been seeing this, it's not too far off to say that might happen.
Look, it wasn't too long ago we sat on this show and we were wagering, you, me, and Will, talking about, well, how many rate cuts are there going to be in 2024? I'm like, oh, there's going to be...
God damn it, he's going to be right.
There will be 3, there's going to be 4, and then, the articles were saying 6 to 8. It's like, that's impossible. That was stupid from the beginning. But, we were already saying, oh, okay, I think there's going to be 3 or 4, because I thought we were going to start in April based on the data. When the Fed says we're going to be data reliant, we're going to be data dependent, and the data is now coming back and showing this, now you can't do it. Yeah. So there may only be 1 or 2.
And a credit to them, that they didn't drop rates this last time, because look at what came out.
Well, right. It would have. It would then next make inflation even worse because of that. Now, the other part of this too, and this is cited in the article, is that higher inflation coupled with lower than expected unemployment could result in the Fed keeping interest rates high. So we're already talking about interest rates being high, but the lower than expected unemployment. Remember, they stated that they need unemployment to be high. Yeah. Now, they say it in coded words. They say we need softening in the labor market.
People need to lose their jobs.
So
AKA.
Whenever you hear softening in the labor market,
people
that means
need to lose job.
We need higher unemployment. So remember, they needed higher employment to trigger demand destruction.
Yeah.
And then demand destruction leads to lots of supply on shelves, unused inventory that then has to be marked down, which then brings back price stability. So it's this like domino effect. So if you have high, softening in the labor market, which is code for high unemployment, then you have demand destruction. Demand destruction leads to higher inventory on shelves. Inventory on shelves leads to price markdowns, which leads to lower prices, which leads the Fed back to saying that they have achieved price stability in the markets. So that's a lot of steps in between where we're at now and what they're hoping to happen.
Yep.
But if that is still the game at play, when's that going to happen? Because now looking at this, what's going to happen? That means you still need more unemployment because it's been lower than expected, even though they've taken rates as high as they have and kept them as long as they have. Now what do you do? So if that hasn't done the trick to get unemployment high, what would you have to do?
So it goes perfect with what CEO of JP Morgan said, Jamie Dimon. It's going to be sticky. And I was actually listening to another podcast this week. So when I read this, I was like, wow. He's expecting, and they're the biggest bank in the United States, hold over trillions of deposits. He's stating that, hey, we're not so out of this yet, and I don't even think we're even close to it. He's actually predicting that rates could go higher, pushing into the 8 to 9%. Then he took it back and said...
Mortgage rates, not the Fed rate.
Yeah. And he even went back and said, like, dude, this is still, on average, very low for the average of the last 50 years. He's like, he pushed back to the 50s and 80s. I mean, the 80s, the 90s rates were way, way, way more elevated. So the only issue here is that prices are still so high. So... Right. If that was to come down, these rates are nothing to be scared about because it's online with everything that's been averaged in the last 50 years. So I think that, he might be actually right because with everything coming out, I'm not sure that it's going to go that high, but I do believe we're going to remain in elevated ranges for the remaining of the year.
Yeah. No, we will. Yeah. I mean, but the thing is that this, and I know this, I've been watching this in the comments too, like this is crushing people. Yeah. This is crushing people that are working their full-time job plus maybe a side hustle or 2 full-time jobs. I mean, I literally just the other day was talking to a neighbor of mine who is working 2 full-time jobs. He's going to work early for one, pulling a morning to midday shift at one job full-time, and then going to the second job doing an early afternoon to early evening shift for a second full-time income. And he is in a house where 5 other people live, they all share rent, and he's renting a room there. So he's got 2 jobs and renting a room inside inside a house in our neighborhood, and that's what it takes for him to make it. He's single. He doesn't have any other expenses outside of his own personal expenses. Right. He does not have any children, and I'm talking about someone who's in their like late 20s. So that is, I know, only one example, but that is happening to a lot of people. This elevated interest rates for higher for longer is going to continue crushing people, especially in the middle class and the lower and the poor, lower class, poor, whatever, economically disadvantaged, if you will.
100%. I mean, the higher the rates go, unfortunately, the people at the bottom of the barrel are the ones that hurt the most, and it's it's a bad situation, but.
Well, but even if you're making, let's say, good money, I'm going to say good money. Let's say you're making $100,000, $150,000 a year. A couple weeks ago, we were talking about that folks need to have 80% more income in order to afford a home these days. Well, that could be a married couple that combined make $150,000 or $200,000, and it's still tight. I mean, I'm seeing articles online where people saying that even if they make $150,000, $180,000 a year, they're paycheck to paycheck.
Yeah.
Like, that's crazy.
I met with with 3 siblings this last week, and I mean, all of them wanted to buy a house, and they're like, hey, they came to me, they're like, hey, so we all work individually. We wanted to see what route would be the best. Should we all buy together or should we buy individually? So we calculated their income. One of them made $43,000 a year, the other one made $53,000 a year, and the third one made $65,000 a year. I mean, right off the bat, I looked at him and you guys are probably better off buying together because now you have $161K income. So now that puts you in the ballpark to actually be able to, content to be able to buy something. And when I say content to be able to buy something, we're still working on their debts because even at 160K income, their debts are still holding them back for certain things to be able to buy. Yeah. So, even at that income, you're still going to face certain obstacles with rates being so high because of how much it eats up on your debt to income ratio.
Yeah. I mean, it's chewing away at your affordability.
Oh, 100%.
And you're not your affordability, chewing away at your purchase power.
Yep.
So, and that is just likely to continue happening. The issue with the Fed is they're damned if they do and they're damned if they don't. Yep. If they leave rates where they're at, then it's going to be pursuant for longer. If they increase rates, then they really got to tuck tail and they're going to take a black eye in the media and in public because they really got it wrong. And then if they reduce rates too soon or too quickly, then they will not achieve unemployment that they need in order to create demand destruction to get price stability back, and then price spikes will happen again. And again, I know they're trying to achieve this like leveling off, but as long as we're in positive territory when it comes to month-over-month inflation and year-over-year inflation, it's still growing. It's not stabilized. It's not flattened. And for people who don't take a close enough look at this, the charts are really disingenuous because the chart looks like it goes like this. It goes up, Brian, and it kind of levels and it goes down. But it's a positive growth chart. It's not a zero midline waistline with positive numbers and lower numbers. It's just a chart of positive only, and so it represents growth and speed. It does not represent contraction at all.
So,
but it looks like it does.
I heard an interesting and maybe a little bit off subject. I heard, what if we were to go back, and I wanted to ask you this, Andy, what if we were to go back to the gold standard? And one of the arguments that they brought up is like...
Wait. Are you watching like Peter Schiff videos? Or something?
Yeah!
Oh, okay. Oh, geez.
How did you know?
Because he's been talking about the gold standard for forever.
So, I mean, I fell across that video that he was talking about. He's like, and I was curious because he said, if we go back to the gold standard, then we can't run a deficit, meaning that there's no, running deficit, bringing debt. What does that mean, Andy?
There's a massive rabbit hole you're about to go down in this conversation. Like, this is an entire show talking about the gold standard being backed by gold. Where is all the gold, actually, by the way? Okay, so my I'm not going to be conspiratorial. I don't know where the gold is. I'm not sure that if anyone knew where the gold is, the public would be told where the gold is.
Where's the gold?
Number one. Number two, I don't know that for the amount of gold that, let's say, physically is in existence and is held, you could attribute that and correlate that to how much deficit we're running in the 30 some odd trillion right now, because then you would need to have that much gold at its current price in order to equate that standard. So there'd be some sort of ratio, 1-to-1, 2-to-1, whatever it is. So there's that issue. Number two, gold is traded on the open market. So you can actually trade physical gold, you can trade paper gold, and so you can hold gold in your portfolio without actually even having material gold in your possession. So the tradability of gold is something else that you have to, because it has volatility too.
Right.
So the gold price reacts to the market when inflation comes in hot or cold, and employment goes up, and world events happen, so it's exposed to the market. I think the real issue when I hear about the gold thing is that we came off of the gold standard a long time ago, which then you can argue now, looking backwards, it really negated any sort of monetary policy you would want to have after that, because, if it's off the gold standard, then you can kind of do whatever you want. And then we're only beholden to the people that hold our debt. So whoever's holding all our debt are the ones we have to answer to, not to some standard. Does that make sense?
Yeah, it makes a lot of sense.
So let's say foreign countries own trillions of dollars of our debt. Well, then that's who we have to answer to. We don't have to answer to our people and to the gold standard we have set.
Because they're the ones that pay the bills too. We pay every month.
Even though we owe trillions of debt to these countries that are holding our debt, well, we just have to tell our people that they're going to make it and their dollar still goes a long way, which it doesn't. So the devaluation, the dollar is part of this. I know I gave you a long answer. You didn't even ask for it. But
no, I didn't.
That's a whole different topic.
Now I have stuff I have to go to do some research on.
It's a whole different topic.
We'll be back next week with the gold standard update.
So with Realtor.com, the shelter inflation is about a third of the goods and services that are measured in the consumer price index. So things associated with shelter inflation, and we have to have food, clothing, water, shelter. Those are our core necessities as people. Other things like transportation and food and those kinds of. I mean, I just mentioned food, but fast food, like the things that we go out and to do outside of our core necessities. Those don't carry as much weight as the shelter connected things, and the shelter connected things are going to drag the market for very long. Now, I also saw that there has been deflation in certain categories and certain raw goods, and also in certain farm goods, but those deflationary numbers are only taking those goods back to where they were from plus 40%. So, for example, I'll use, I think apples came in, apples is down 10%. Okay, that's great. So year over year, apples is down 10%.
I'm going to short apples.
But when apples were up 30%, and then I'm down 10% from that, that's not actually as cheap as it was before it inflated 30%.
You're just back to where it was the most affordable at the most recent time.
Well, you clawed back a little bit of it, but if your weight goes up 30% and then it goes down 10%, you're still
I'm still up 20.
You're still heavier than when you started. So that is the point, and such goes.
But we don't talk about that 20. We just talk about that 10% loss.
Such as it goes with mortgage rates. Mortgage rates are going to walk in lockstep with what inflation does, because that's what it's going to do. For those who are looking to get into the market, it's still going to be a long-term play. It's going to be something you have to buy and hold and be committed to. It is definitely not a fly-by-night decision right now.